This year we did just over 1.3 million in payments for 24 clients, and if you have any confusion at all on IUL, we're going to walk through front to back what is Indexed Universal Life and how does it work. IUL stands for Indexed Universal Life, so it's a form of life insurance. This means you must qualify for a death benefit based on yours or someone else's age, health, and gender. You then will pay premiums each month or year for that death benefit. Different than regular term insurance where you can just pay premiums and get a death benefit, with Universal Life you can pay higher premiums and have part of that go towards the cost of insurance and part of that go towards a cash value account. If at any point while the policy is enforced the insured passes away, the death benefit will transfer income tax free to the beneficiary. How big that death benefit will be depends on the funding from the payer and the structure of the policy. This is the most important point in this entire video. All universal life policies are not created equal. Before someone gets a policy, it is the job of the insurance professional to design a policy to fit the client's needs. If the client is looking to maximize their cash value to use while he or she is alive, then the client, as you might expect, would want the least amount possible as defined by the IRS to go towards the cost of insurance and fees, and the most amount possible to go towards the cash value. If you flip-flop this, you will have a much higher death benefit and a much smaller cash value, which is fine. However, generally when an agent is trying to convince someone to do this, it is because they will get a much higher commission, even if you are paying the exact same premium. Also, unfortunately, because these products are very complex, it's not uncommon that a well-meaning agent will structure one improperly, which will really damage the client's future and help their pockets. To make sure the least amount of premium is going towards the cost of insurance and fees, we have to calculate the minimum death benefit. To do that, we need to comply with the tax IRS code 7702, which helps define what that is. In 1980, when Universal Life was first introduced, we were able to pay a much lower percentage towards our cost of insurance and a much higher percentage towards our cash value. This was quickly changed in TEFRA of 1982 and DEFRA of 1984. This is essentially because insurance companies are not wanting people to move over $1 million, where $1 is going towards the cost of insurance and $999,000 and change is going towards the cash value, just to take advantage of the tax codes. This can all be calculated very simply and easily by the agents. They just need to use the insurance company's software when running an illustration for a potential client. And this was also altered in 2021 to lower the percentage, actually making it a little more beneficial to the policyholder, meaning less has to go towards the cost of insurance and more could go towards the cash value. Once then the minimum death benefit is determined, there is a variety of ways to begin funding the policy. The first is through income or cash flow, the second is through lump sums, and the third is a mixture of both. Keep in mind also, all of these are being funded with after-tax dollars. Now, regardless of how you actually fund the policy, you're always going to have three very important metrics. The first one is going to be the minimum amount that you need to make sure the policy stays in force. That's called the minimum monthly premium. The second one is going to be the maximum number that you can fund the policy with. Generally, if you're funding with cash flow or income, that's the guideline annual or level premium. And third, you're going to have a number that's a little bit higher than that, is the fastest way to fund the policy, usually going to be for lump sums. That is the MEC premium or the TAMRA/7-pay premium. This last metric, the 7-pay premium, this is due to TAMRA of 1988, 8 years after Universal Life is born, to slow the funding process. Even though the minimum amount of insurance was defined earlier in the decade, it is still becoming increasingly more difficult for banks to compete with the tax benefits. So this is no longer going to allow people to move over one lump sum on the first day, and instead requires them to spread it out over a period of time, usually close to 5 years. Now, whether you are funding with the minimum premium, the guideline level premium, or the guideline annual premium, you are always able to switch between these. For example, if you were just funding with cash flow and income using the guideline annual premium, but you came across a hardship and needed to lower the premium to the minimum monthly for a while, you could do that. If you were just minimum funding a policy, just putting in the minimum, and you came across a whole bunch of money or you completely had a change of plans and wanted to switch all the way to the TAMRA premium, you could do that. Regardless of all of these metrics though, the main goal is always going to be to fund the policy with the guideline single premium as fast as you can. This is going to be the maximum amount that you are planning to move into a policy. So if you are moving over a lump sum of $1 million, your guideline single premium is going to be $1 million. Sometimes earlier than this point, but usually once the guideline single premium is hit, the agent will be reducing the death benefit and if necessary, switching the death benefit type from increasing to level. These are very small tweaks that the agent should be assisting the policyholder with. Assuming the policy is now structured for maximum cash value and is being funded, the cash value will begin to get credited interest. This is going to function very similarly to a high-yield savings account at a bank. Banks function by investing their money, earning a rate of return, say 5%, and therefore they're able to credit their account holders a little bit lower percentage, say 4%. Insurance companies are actually doing the same thing. This is what's through their general account portfolio. These are things like mortgages, government bonds, and these are always going to be much safer than banks when they're earning their returns. In fact, this is why many banks keep a lot of their liquid cash in insurance companies. So if someone has $1 million of cash value in their life insurance policy and the insurance company's general account portfolio account is earning 5%, they may be able to credit that cash value, say 4%. Because this cash value is considered life insurance and not an investment, this cash value is going to be growing tax deferred, which is a big bonus. I will get into the tax-free portion of things later in this video. Now, if you wanted to just keep that interest and let that continue to compound over the years, you could do that. If you wanted to use that interest to try and earn a higher rate of return without risking your principal, this is where options come into play. If you would like, the insurance company will give you a list of indices to choose to link your principal to. Your money is not in the market, your money is linked to the market. This means if any of the indices you choose over the time frame that you select go down, you will not lose any money due to that. If the indices go up over that selected time frame, you will receive whatever they go up to a maximum percentage or a cap. For example, if you chose to link $1 million in cash value to the S&P 500 with a 1-year point-to-point with a 10% cap, if the market went down 10, 20, 40%, no matter how low it went, you're not going to lose anything because of that. You would still have your million. If the market went up 10%, which is its cap, you would receive that. If it went above the cap, so it went up 15%, you would only receive up to the cap, in this case 10%, making it 1.1 million. Since this period is now over, the gains that you made in that period are now new principal. This means if you made 10% and got up to $1.1 million in cash value, that's your new principal. That's the lowest you can go due to market volatility. If the market goes down next year, not only do you keep the million, you keep the 1.1 million that you made in the last period. This is what's called locking in your gains and resetting. Think of it like a ratchet wrench. When you turn the wrench to the right, the bolt is going to get tighter. When you turn it to the left, the bolt's not going to get any looser, it's just going to stay still. But when you turn it back to the right, it's going to continue getting tighter again. We're cutting out the loss years. Same thing with the wrench. We're cutting out, loosening up the bolt when we turn it to the left. This is possible through options. So to zoom out a little bit, if you had a home that was worth $100,000 and I wanted to buy that home, but I didn't want to buy it today, I wanted to buy it a year from today. What I could do is I could give you an options budget or pay you the cost of whatever those options are to decide if I can purchase that home for the price it is today, $100,000, a year from today. So if we play this out, if the home went down in value to $80,000, do you think I'm going to buy it for $100 when I could buy it for $80? Of course not. If the home went up, however, to $120,000 in value, am I going to buy it for $100 when I could buy it for $120? Of course I'm going to buy it for the cheaper price. And now even though I bought it for $100, it's worth $120,000. I instantly made that $20,000 gain without risking my $100,000. I just paid the $3,000 options budget to allow me to do that. The exact same thing is happening with these indices. So if the S&P 500 went down 40% in a year, do you think I'm going to buy it right before it crashes? Of course not. If the S&P 500 went up 10% in a year, do you think I'm going to exercise that option to buy it right before it goes up 10%? Of course I am. Now this has just been with a 1-year regular cap choice. There's also monthly choices, 2, 3, and even 5-year linking periods. On top of the length of those, however, there's also participation rates, spreads, multipliers, and bonuses. First, participation rates are the percentage of the index's return that you will get credited. So if an index performed at 10% but had a participation rate here of 50%, you would only get 5%. If you got 100% of the 10, well, then you get the full 10%. If the participation rate was 200% and we performed at 10, that means we would get 20%. Second is spreads. These are generally used to get a higher cap rate, and they are going to be the percentage that are subtracted from the index's return, but not below zero, so you're still going to have the downside protection. In the first example here, if we had no spread and just a regular 10% cap rate and the index performed at 30, we would of course hit our cap rate and we would get credited 10%. Now, if you had got a little bit higher of a cap by having a 1% spread of 15%, then since the index went above that cap, we would get 15%. Now, here's an example of an index someone might choose if they don't want to miss out on a good market year. So if the market did perform at that 30%, but they had an uncapped index, but they paid a 7.5% spread for that, in this case, they would earn 22.5%. The danger of using an index like this is if the market only does perform at 10%, well, then they're only going to get 2.5% return, while if they hadn't had any spread at all, they would have got the full 10. Third is multipliers. It's just like it sounds. That is the number that you're going to multiply the index's return by before you subtract the fee that you would pay if you did decide to use a multiplier. Now, these can be very lucrative. They can make no effect at all, or in the worst case, they can actually drop your floor below zero. Some people are okay with taking that risk, but let's take a look at a couple examples here. So if we had multipliers of 1.5, 2, and 2.5, with the fees for those being 2.5, 5, and 7.5%, here in the best case scenario where the cap is 10% and the return is 10%, you can see we're able to tweak our returns net of those fees up much higher. So 12.5, 15, and 17.5% return. It's completely income tax free, and that's your new floor for the next year. Now, when they're completely neutral, as if the return was just 5% there, yes, you would still multiply the 5% by that multiplier, the 1.52 or 2.5, but then after that, you would have to subtract the fee and you'd end up right back where you started. So you started with 5% and you're ending with 5% in this case. Now, when they get a little bit more dangerous is when any of those indexes do go down, 10%, 20%, 40%, you still do hit your floor of zero, but you still got to pay the charge. So if the index went down 40% in any of these, you would get negative 2.5, negative 5, and negative 7.5. Some people are totally fine with this. They say, hey, if everyone else lost 40% and I'm only losing 7.5, I'm willing to do that to have a chance of getting a much higher return. Other people want absolutely nothing to do with it. They signed up for IUL specifically because of those 0% floors. They do not want to lose. Regardless, these are an option that you have, and you can change these year to year. And finally, a bonus. This is the percentage added to the final return on an index that you selected. So if there was no bonus, of course, you would just get the 10%. If there was a bonus and the market went down, remember that we have the 0% floor, so we're still actually going to make a little bit of a gain even when the market went down if you had an index with a bonus in it. And then if the market did do well but didn't go up to the cap, say it was 5%, you still get that 1% added. You would have a 6% crediting rate. While there are lots of choices and these are going to vary from company to company, it's usually as simple as selecting your indexing allocation at the beginning of the year and leaving it until the very next period, where just before then, you can reselect a new strategy for that next period, usually done at your annual reviews. Now, while it's totally okay to just pick it one time at the very beginning of the policy and never touch it again, it may be worth it to look at each annual review and see if it's worth switching strategies. The reason for this is the participation rates, the cap rates, the spreads, the multipliers, the bonuses. All of these are subject to change, and there may be a good deal to take advantage of for the next linking period that you don't want to miss out on. So you can do that, and you always have the opportunity to just move back into the fixed account and just keep the interest that you're getting credited from the general account portfolio. The next thing to note, on top of the linking methods you're using to earn your returns, is the fees that come along with IUL. These vehicles are very front-loaded with fees, generally in the first 5 to 15 years, making them not a very good option for quick money, but rather they are long-term vehicles. The good news is you will be able to view down to the dollar amount the projected fees that you will pay by running an annual cost summary. Some companies will even show a monthly cost summary. The two main front-loaded early year fees are going to be the premium charge, number one, and then number two, the per 1,000 base charge. That's going to be the one that is spread out over 5 to 15 years, depending on the company and product. In this example, I chose a 45-year-old male moving over $1 million over the course of 5 years. You can see first, I'll pop this up now, the premium charge. He has to pay that each time he puts in premium. So over those first 5 years, he is paying the premium charge, and then that is done. He doesn't have to worry about that. In this example, the per 1,000 base charge is spread out over 10 years. So after those first 10 years, if we switch to the next slide, we are going to see that cost is completely gone. All we have left to worry about then is the cost of insurance. As long as the policy was structured properly, what you'll notice is as I continue throughout the years here, as a percentage of the total cash value here on the right, the cost of insurance begins to become negligible. The reason this cost as a percentage of your cash value is actually able to decrease over time, however, is because we are on an annual renewable term basis. This means, of course, as you're getting older, you are more likely to pass away, and your cost per $1,000 of insurance is, of course, rising. However, the amount of $1,000 of insurance that you're actually paying for as your cash value is growing is going to decrease. For example, if you were at a point in your policy where you had $500,000 of cash value and a $1 million death benefit, you would still be paying for $500,000 of insurance. Now, is the cost per 1,000 going to increase over the next year? Yes, it is. But if you had a 10% gain that year and now you have $550,000 of cash value and only $1 million of death benefit, well, now you're only paying for $450,000 worth of insurance. As that cash value continues to grow later into the policy, when you have $800,000 worth of cash value, you still have the $1 million death benefit. $800,000 is considered part of that death benefit. So how much insurance are you paying for? Only $200,000. Even with all of this information, it may still seem like a very fee-heavy product and therefore not worth it. Because this is a reasonable conclusion to draw with only the information presented so far, I also recommend, on top of running the annual cost summary report, running an internal rate of return report. If you're not sure, is this too expensive? Is it not? This gives you a very simple number to look at and draw clear conclusions from. This number says, assuming the policy performed at the illustrated rate and you funded it as planned, here is the rate of return you have actually earned once you subtract all fees, all costs, tracking all the way back to day one. Now, what you'll notice with this chart here is the internal rate of return on the surrender value is much worse in the beginning years. That is because of those early year fees. Like we said, IUL is a long-term vehicle. Once you get farther along, however, keep in mind this policy is illustrating at 6.42%. Once you get 15 years in, the net fee there, 6.42 minus 4.87, is 1.55% per year. Still not great, but much better the longer you wait. If you see in this example, if we scrolled all the way down to 30 years out, we have an internal rate of return of 5.74%, assuming the policy performed at 6.42. 6.42 minus the 5.74, that is a 0.68% fee. That is calculated using the internal rate of return calculation. I'll pop that formula up here, but this is not only taking into account how much money we're putting into the policy, but when we put that money into the policy. And that is how we're able to get that very accurate number of tracking all the way back to day one, what has been our true internal rate of return. Keeping in mind in other investments or vehicles, you might be paying management fees or taxes, and this is where someone really starts to see the benefits of a properly structured maximum funded contract. If you notice there, I just mentioned taxes. Earlier I mentioned that the cash value inside of a life insurance policy, because it is not considered an investment, is growing tax deferred. There's actually a couple more benefits here. So first is withdrawals. If you would like to access your money via withdrawal, they are taxed first in, first out. The pros here is that they are tax-free up to your initial amount that you put in or your initial funding. The main con is if you try to withdraw more than you actually put in just from the gains, because they are tax deferred, they are going to be fully taxable, just like a 401k or an IRA. Number two, instead of withdrawing money above what you contributed and having to pay taxes, you can actually access this money tax-free via policy loans. The terms for these are going to vary across companies, but typically there are two main types. The first one being a standard loan, sometimes referred to as a fixed or a zero wash loan. The biggest pros to these, of course, the tax-free access. They are a fixed rate and you are credited interest to offset that rate. The biggest cons, however, are that fixed rates can rise. They are not available in the early years. A little example of this and why they're called zero wash loans sometimes is you might be loaning, for example, at say 2%. That's what you are paying on your loan, but the insurance company is also going to credit you 2% as well. So it's like a zero wash. Yes, you are loaning and paying 2% interest, but you're also getting credited 2%. So it's a zero wash. And then the biggest con there was that crediting rate can rise So there is scenarios where an insurance company does reserve the right to technically charge 3% and only credit you 2%. This is why it's always important to go with a company that has a good track record of treating older policyholders well. The second and most popular main type of loan is an indexed loan, otherwise sometimes referred to as a variable loan. What these allow people to do is, even though they have loaned the money out, spent it, done whatever they have wanted to with that money, it will leave that money still linked to the index they chose before loaning. That leads us to the pros, of course, the tax-free access, but the main thing there is the opportunity to earn arbitrage on those loans. The biggest con that comes along with that, though, is while there's opportunity to earn positive arbitrage, there's also opportunity to earn negative arbitrage if the index performs below the loan rate. A good example here of a time that this would be advantageous to use is if you were loaning at 5%, but the index, let's say it was the S&P 500, performed at 10%. Even though you paid 5% on that loan, you gained 10 on the money that you loaned out. Therefore, you netted 5% on money that you've already taken out. It wasn't even in the policy. Now, on the flip side of things, if you were paying that 5% loan rate and the market went down, you hit your floor of 0, therefore your performance was 0, you're receiving a net gain of negative 5%, essentially meaning you did just have to pay the 5% interest on that loan to be able to access it tax-free. Of course, the idea is that the index is outperforming the loan percentage over time, and you're able to earn that small arbitrage on the money. Finally, the exact terms will vary from carrier to carrier, but generally you can switch back and forth between standard and index loans at least once a year. This means just as you might switch money from being linked to an index into the fixed account because you're not feeling great about the market, you can also switch from an index loan over to a standard loan if you'd rather take the zero wash for this year rather than actually being linked to the index and hoping that it performs well. So at those annual reviews where you are deciding if you want to change indexes, this is also a conversation you would be able to have with your agent. Even earning just a 1% arbitrage on the index loans over the course of the policy may not seem like very much in any given year, but over the long haul can make a big difference. Now, while the tax-free access may sound great and even earning a positive arbitrage, a lot of times people are worried about a big loan balance. Do I have to pay that back? The short answer to this question is no. If you would like to pay this loan back, you are more than welcome to do so. In fact, this can be a very large benefit to people having a large loan balance. Maybe they were taking tax-free retirement income, they come across a settlement, an inheritance, and they are able to dump that all into a policy with one big lump sum instead of having to open a new policy, spread that out over multiple years. So these can be great for business sales and property sales as well. Now, someone might think, even though this is getting tax deferred status and we're accessing it tax-free via policy loans, certainly we will have to recognize this deferral status at some point and pay off those loans. The loan does at some point actually have to get paid off, but we do not have to realize that deferral status ever. That is because when we pass away, what's happening is the death benefit is actually paying off our loan balance first and then transferring to our heirs income tax-free. In this example, if there was a loan balance of $200,000 and a death benefit of $1 million, it's going to follow this very simple two-step process. First is the death benefit pays off the loan balance and the remainder transfers to the beneficiary. In this case, even though the death benefit's $1 million, the leftover that would be transferred is $800,000. This is exactly why, even though some people do not like the term loan, they see the big advantage to loaning their money out instead of just withdrawing. As with any financial strategy, there are warnings to give. The most prominent one to be aware of the caps changing and the treatment of older policyholders from the insurance company. The cap rates, the participation rates, the spreads, the multipliers, all of those that we mentioned earlier are subject to change. These generally are going to be based on the general account portfolio changing, volatility rising, the cost of options increasing, and contractually speaking, if the insurance company wants to. Perhaps they're not driving any revenue from older policyholders because the fees are so much lower in later years, and they're wanting to drive more money into marketing a new product. Unfortunately, this can happen and has happened. That is why I stress not only the importance of going with a large company, but primarily a mutually held company. Of course, this means they have less incentive towards the stockholders and more towards the policyholders. Even then, there is very few companies that have a great track record of actually treating their policyholders well and even lowering the cost of insurance over the years. The worst cycle that can happen with this is that companies will advertise their products with higher caps than everyone else. People will get those products because they think they're going to get the best rate of return in the long haul. Then, shortly after getting the policy, the companies would lower the cap rates, use that extra money to market towards new products that just came out, forget the older policyholders, focus on their new ones with their high cap rates, and repeat that cycle over and over and over again. This, of course, is not a trap you want to be a part of. Other warnings, mostly due to user error, would be underfunding the policy, not getting enough in, overfunding the policy, or getting the right amount in but funding it too quickly, creating taxable events, trying to take out more money than you actually have in the policy, trying to use the policy for too many things. This might be like using it as a working capital account for your business, but also for retirement income. It's not magic. And worst of all, not having a plan for if the agent leaves the industry and someone to continue to check up with you on an annual basis and make sure you're on the right track and make those small tweaks that you might need to make with your policy. As a quick summary, before getting into the uses, maximum funded index universal life insurance that complies with the IRS tax codes function by having cash value after funding the policy, having that cash value getting credited interest, and using that interest to buy options to link to an index. That cash value can then be accessed tax-free via policy loans, and when you pass away, the remainder transfers income tax-free. IUL is a long-term vehicle that takes patience awaiting the paying of early year fees to eventually allow for a strong, tax-free, fee-free internal rate of return without the worry of losing due to market downturns. With that summary, what can IUL be used for? Of course, as alluded to in this video, many will use it for tax-free retirement income, but it doesn't stop there. The best way to do this, instead of creating a yes and no checklist, is looking at the pros and cons of IUL, the functions of it, and asking yourself, what can I do with this? Couple examples. First would be a working capital account, somewhere where you're keeping money to earn tax-free, safe rates of returns while still remaining liquid. This is the most important thing, especially for business owners. And then, of course, you can borrow large portions of the cash value at a time to fund a business or an investment, maybe planning to pay that back later on. And of course, hopefully while you are taking those large loans, if you're doing it with an index loan, earning an arbitrage on the loans. A couple things that are pretty similar to that: building up cash value and then accessing it in terms of a lump sum, of course, would be college planning, business planning, emergency funds, purchasing real estate, or even large donations. Estate planning is another way this could be used. Of course, since the money is going to be transferring income tax-free, this is a big benefit. And if someone was planning to max fund a policy or to reduce the death benefits at some point, but they had not yet completed those things, and for whatever reason, an unexpected, likely fatal illness was to come upon that person, they could stop funding it, and since they've already been approved for this amount, keep the maximum death benefit, no longer continue funding the policy, and when they pass away, of course, the larger death benefit is going to transfer. You could also minimum fund a policy with the ability later on, if the policy was going to lapse and you were just paying that minimum premium, to put in a lump sum to keep it enforced. In this case, however, a big warning, it's not my favorite because you are essentially taking a wager on the fact that you're going to pass away early, and you're taking that wager against an insurance company who have actuaries who are calculating the likelihood of these things happening daily. Just two last examples here. First is the most popular, the strategic rollout. This is getting money out of tax-deferred accounts, getting the taxes over and done with. This is generally for people who are maybe expecting to be in a lower tax bracket in retirement, but actually this is not going to be the case. Of course, the goal is getting taxes over and done with, not only opting out of the market volatility, but the tax rate volatility if taxes were to raise, brackets were to change, deductions were reduced, etc. Keep in mind, for retirement planning might look much different than at retirement planning. And then how this would actually take place is by rolling out a certain amount each year from the IRAs, the 401ks, paying the taxes, and then funding the new policy with the TAMRA or the 7 paid premium. And lastly here, pension maximization. This is a very unique strategy for school teachers or anyone getting a pension, generally where they have two options. The first is they can take the full amount that they're going to be guaranteed the rest of their life. And the second is they can take a little bit smaller amount, But if they pass away first, it will still be guaranteed for their spouse to continue receiving that until they pass away. Most people elect for this option because they don't want to take their spouse out of the picture. However, if you were to take the higher amount and then instead use the difference to fund a policy, it's going to add a lot of different benefits. The first is that if you pass away, yes, the spouse will no longer receive the pension, but they get the large death benefit of the policy you opened, and they can use that for income. Also, the longer that both of you live, if you were to pass away much later, not only is the spouse only going to get a little bit, but they're going to get that full death benefit that then is going to transfer to your kids, whoever, when he passes away, making generational wealth much more likely. And if the spouse, the second spouse, predeceases the person who's receiving the full benefit, they have a lot of options. Number one, they could change the beneficiary to their children. They're still receiving the full amount. Or number two, if they ever get remarried, they can change the beneficiary to the new spouse. Or none of these, they could just start accessing the cash value of the policy that they've been funding. Finally, here's a number of examples of real in-force policy statements from a mentor of mine, that's Imran Andrew, to show you what's actually possible with IUL. First, we'll start with a bunch from this year. This one matured in August from the past year. You can see this person has a little over $1 million in cash value and earned a little over $200,000 this year. This next one is from later in August. This is actually a 14-year-old policy, and this client is 73 years old. You can see there the policy's average interest rate is 8.64%. These next ones are from September of this year. Keep in mind these returns are all completely income tax free. You can access them via policy loans. Feel free to pause if you want to take a look at any of these. You can see there's a number of different strategies people are using here. Some have multipliers, some do not. Some are just in the high cap indexed accounts. Some use 2-year with multipliers. So you can really have a variety of different options here. This one's from October of this year. You can see this policy has averaged 9.76%. This person has about $2.7 million of cash value, completely income tax free. This one here is also from October. You can see is about $255,000 in cash value, but I specifically wanted to show this one because this person's using a 2-year indexed account with a 2.7 multiplier. You can see this interest here, the 17%. This is from the past 2 years, so it's technically a little less than that, but you can see over the past 2 years, he's gained $84,000, and that doesn't include the 1-year indexed from the last year. This policy here is a 13-year-old policy. I wanted to show the fees on this one. The charges $396.10 when he has an accumulation value of $224,000. Fees on this, that's 0.167%. Another policy here entering its 13th year, accumulation value started at $211,000. He paid in $42,000 and he gained $25,000 income tax free. And how much did he pay in fees? Less than $450. Another example of low fees, this person had a little over $800,000 in cash value. At the end of the year, $853,000. Can pull that out completely tax free, and his fees 0.1876%. Here's an example of a bigger policy. This person's likely using multipliers. You can see this person had $1.6 million in cash value. At the end of the year, 1.76, again, completely tax-free. Same deal, another one here in November. This person's using a rider charge they don't necessarily have to have, but they started the year with $389,000, ended the year with $425,000, made that gain income tax-free. Now here's some examples of some much older policies, not just from this year. This is from another mentor of mine, Aaron Andrew, that's Imran's brother. You can see this policy here has averaged 10.86% rate of return. That's before fees, 13-year-old policy, and this client has not even fully funded the policy, about $60,000 short of what he was planning to. Still, you can see there on the left, over $480,000 of income he can take completely tax-free. Another example, this is a 10-year-old policy, averaged 9.25%. See there on the left, $558,000. Another one, this one's from Imran. This is a 9.74% average. This is a sales professional that used this policy. You can see it's at $299,000 there on the left. This one's well ahead of schedule as well. Here's a 9-year-old policy from 2022. This policy is a $571,000 accumulation value, and the projection for where it would be in 10 years was $530,000. So even with a poor return this year, still way ahead of schedule. This policy is from 2010. That's a 9.56% average. You can see there on the left, much smaller policy, $70,000, but still nice return nonetheless. Last example here, this one's difficult to see, but it's a big one. So this one has $2.3 million in cash value. You can see there on the left. Client can take that out completely tax-free, and it's averaged 7.96. This client only put $1.25 million into this policy. Now he can take all of that out tax-free. Hopefully this video was helpful. I wanted to make one that tried to include almost everything there is about Indexed Universal Life into one video. If you have any questions about any part of the video, please do leave those below. I will make sure to respond to each and every one of them. Subscribe, and if you would like to take a look at a policy for yourself, see how this could change things for you, your retirement, your business, whatever that might be, book a 20 minutes quick consult with me in the description, and I would be more than happy to help out. Bye-bye.